Jay Papernick is back with me this week from Assante Wealth Management. I just got that wrong. What did you just say?
Assante Wealth Management.
Yeah?
You got it right.
Okay.
Just say it with a little more conviction, like you're aware of the
Jay-
company.
Jay Papernick is back from Assante Wealth Management. He was just here, but he does not bless us with his presence very often. Comes back and forth from Israel. I'm so glad that you are safe and everybody is safe.
Thank you.
And I'm so glad to have you back because
Glad to be here.
even though we talked about the fact that you were just here and we were wondering like whether the markets have changed or, was there anything new to talk about? First of all, you and I can talk for hours. But things have changed.
Yes.
And it is a crazy time. I actually feel like things were ever changing until the summer. And then the last 4 months, it's been stagnant. Like nothing's happened. I actually was saying to a client the other day, I really feel like we've hit the bottom. I feel like the bottom, and now maybe the next couple of weeks will continue like along the bottom. But I think that we're in that like bottom trench now. And my hope is that 2024 is recovery for us. And that means a lot of different things, and we'll qualify that. But I do kind of want to get your perspective on the market specifically, like not the real estate market, but the stock market, obviously intertwingle, all that stuff. But yeah.
So
I was about to say intertwangled. I just want you to know that,
intertwangled's not a word.
But not a word.
Not
So
a
I
word.
stopped myself, but I
Yeah.
thought I'd throw myself under the bus anyway. Yes.
Intertwined. They're not twangled. That's fine.
Everybody who knows me finds it even
Yeah.
funnier because I make up my own words
get it.
sometimes. But anyway, yeah.
It's actually not the stock market that's more interesting these days. It's still the bond market. And it's so from a markets perspective and from an investment perspective, this year continued up until the last time that we were speaking, interest rates were still going up. And then since then, the only thing that's really changed is they started to stop raising interest rates. They're getting lots of data that says that the rate rises, the increases that they've done over the last year and a half are starting to impact the economy. And that's the goal. So if you remember, why are they raising rates? Is to fight inflation. And how do you fight inflation? You create higher interest rates, which creates a recession. You need the numbers to go down. And the numbers started going down.
And I think just to qualify that even more and to break it down is that they needed people to stop spending money.
Yeah.
Right? So we know, and we talked about this, what was the number that the government overspent? Thank you, Trudeau. You're just fantastic. Sorry to get political for a moment, but I think that they paid out like 400 billion more like in CERB than people lost jobs. Yeah. Like there was something of that nature. So people who had locked in at 2% mortgage for 5 years, those first couple of years, people weren't stopping spending money. They had more money in their pockets, and money was free. Yep. And they started raising interest rate. And I don't think it, again, as they say, it takes about a year to 18 months for the economy to see the effects of it.
To get it to kick in. Correct.
And we just had Alex Luduk, actually, who's the founder of Perch Mortgages, which is an online mortgage brokerage, very data entrenched. And I was saying to him, I think that those two interest rates that happened in June and July were the worst psychologically. And as we know, our whole business is markets are psychological. Real estate is psychological to a certain extent. And they were very small, but I think it killed across the board. It didn't matter what tax bracket you were in. People that I was talking to all felt it.
Well, and it's interesting because it filters through to bond and stock markets as well. And when you look at, we always say in the financial advisory business and in the investment business, they talk about quarterly statements because everybody gets a quarterly statement. So the June 30th statement wasn't great. And then you see July and August, and the market went up. And by the time we hit early September, the market went back down again. So their September statements weren't great. Since September 30th, the markets have done quite well. They've actually gone back up because those rates stopped increasing a little bit. Federal banks in the U.S. and in Canada talked about pausing, talking about topping out and all those things. Right. So the markets have come back. And what's interesting is not a ton, like they still haven't made up all of their loss, but there is a significant difference between September 30th and November 15th. And it's in those very short 6 weeks that we've noticed that markets have picked up again, but it's qualified because there are certain areas that are still feeling a lot of the stress of the increases. So for example, financial sector, bank stocks have not recovered nearly as much. And everybody in Canada loves a bank stock. But what's interesting is their exposure to these residential mortgages still hasn't hit their balance sheets because a lot of people locked in, and those renewals are coming in 2024 and 2025. So the bank stocks themselves are still, a lot of people believe, at risk. Some of the banks more than others, depending on how much residential mortgage business they did.
Right.
But when you look at investments and you talk about Canadians and how they've invested, almost every person you know, whether they know it or not, owns a bank stock. Because they own it through a mutual fund, they own it directly through a bank stock, they bank with bank stocks. Everybody's using one of the big five. So, the impact of a CIBC not doing well for the next 2 years is way bigger than you think. So the Canadian economy
sorry to interrupt, but because it affects everybody, because everyone has a bank stock in their portfolio.
Pretty much.
That's
Everybody's got it. And then as well, they've also got potentially a product from them. So they've either got a credit card or a mortgage or something from them. And so they're looking at it now saying, okay, what will the bank do to try to recoup some of those losses or all those things? So maybe they've got, it'll be interesting to see what happens on an economic scale. There's two things going on. First of all, we're heading into Christmas season. Let's see how many consumers buy things this Christmas season versus last year.
So what's your prediction? I think the retail sector
Walmart
is going to be hit with a hammer.
Walmart just said they expect it to be lower than last year. They expect it to be not as great. I think a lot of the high-end retailers, the Louis Vuittons and the Hermeses of the world, I learned how to say that from you, by the way, because I thought it was called Hermie.
Follow me for more tips.
It was like an old Jewish guy.
It
was like an old guy named Hermie. Made belts, and then all of a sudden some fancy ladies liked them.
Even because what did I say about Carhartt was about cars?
Yeah, you thought Carhartt was for cars. I thought Hermie was a guy
that sold bagels.
He sold bagels and belts on the
and
side.
And a schmear.
Yeah, like you get a bagel, a lux, and a cream cheese and a belt, like as a bonus.
Okay, yeah.
But
so
the high end guys, I think, will do way less. The medium and the long, the Walmarts of the world are probably going to suffer less because they still provide.
Well, they're basics for sure.
Right.
I actually, interestingly enough, I'm also very curious about the travel sector. So most people that I've spoken to, again, resorts are full, planes are full, fine, but they all bought back earlier this year. And I was telling someone, so we've been going to the same resort for 5 years straight. Right. And continually over COVID, it was just going up and up and up. And finally, as a family, we decided we could buy a car for the amount of money that they wanted. And I thought, and I remember saying it was actually almost to the point of the housing sector. And FYI for anybody who's listening who believes that real estate agents just want to sell you a house to make money, and not to say that there aren't people out there, this is not true, okay? I actually, when prices were going crazy and we were seeing double digits, I felt sick to my stomach because that's not good. It's like you, when you see stocks going up and you're like, I'm going to throw up because it's a bubble. You don't want it to go up. I would sell my soul for just a balanced market for the rest of my life. Let everybody come and go. Anyway,
doesn't happen.
All that to be said, we decided as a family we're not going to go. We thought, we'll find an alternative. We'll do something else. Doesn't matter. For half the price. All of a sudden, I get an email from the same resort company. Black Friday sales.
Yeah.
And by the way, it's not for holiday. I was like, oh, maybe whatever. No, not for holiday.
Right.
For January, February, for next year.
Yeah. They're going to be empty.
Yeah. So our mutual friend with about the plane tickets, who's always saying it's not going to get cheaper. It's not going to get cheaper. Right. It's getting cheaper.
Yeah. I believe that's true as well.
I think it'll all have a recovery. So
interestingly, long term, from the recovery perspective, I actually think those are opportunities, right? So if you think about it, in the next couple of years, an airline stock's probably not going to do great. But in the long run, Air Canada is not going out of business. They're supported by the government. They're the one airline of the country. They're a monopoly for the most part. Yeah. It's an interesting stock. And if it's gone from $22 to $17, and you know that they're gonna still sell enough tickets.
Right.
They had a crazy good quarter just this past quarter. One of the best ever.
Interesting. Well, they've become very lean.
Correct. So bank stocks, the same thing. Banks have fired a lot of employees. They've gotten rid of a lot of expenses.
There's more coming. I heard from someone I know inside the bank.
I buy it. They have to. They have to.
They actually went to the government for approval for a larger layoff than they were allowed.
I believe that's true. So again, depending on, I think it's going to be a little company specific and sector specific. Mm-hmm. But I think that when markets go down in the stock market, the other thing that will happen is the bond market will go up. So as interest rates top out, and we've talked about this before, but as interest rates top out and they start to go down, the value of bonds goes up. So somebody sitting on a balanced portfolio right now, they've got stocks that are going crazy, and they might own technology stocks, which are doing well, and oil stocks, which just dropped, bank stocks, which everybody loves. All of these things are very volatile. Bonds have not done anything for a year and a half. They lost a bunch of money and they did nothing. But they're yielding about 6% right now.
Right.
So you can buy a bond, get 6%, and you pay $100 for that bond. And in the next year or two, it could take 2 years, but in the next year or two, that $100 bond could be worth $120.
It could be.
Yeah.
It could be.
And as rates go down, it will go up. So it's just a matter of how much.
Right.
Bonds could be the new stocks for the next 2 years. That's a really interesting story because you don't need the volatility of deciding whether to buy Walmart or Target or CIBC or TD or Air Canada or United. Right. You can just buy a bond and you might get the same rate of return.
Well, and I think that you make a very good point. And I actually had a meeting with my team the other day about this was, you can have a perspective of like the real estate market or the stock market, for example, right? Like, oh my God, like nothing's selling. And right now, by the way, like nothing's selling.
Right.
Like it's very, very tough. You have to be like shaving every last dollar off. People only want perfect. Everybody wants a deal. That's fine. So you might say, oh my God, the market's horrible. It's not, someone gave me this analogy. I've probably done this on the podcast before, but like you don't go to the beach and look at the ocean and say, oh my God, that's a horrible ocean.
Right.
So you look at the ocean and you're a swimmer. And if it's wavy, it's not a great ocean for you, right? But if it's calm, it's a fantastic ocean. Right. Just flip it around. If you're a surfer, you want the waves. Right. But if it's calm, you don't. So, I said to them, I go, this is the time where you get in touch with every single person who thought about buying into the market. Right. Because is this the opportunity where, you're seeing, and specifically, hot stock tip, like the condo market is right now sitting in a generously solid buyer's market. So if someone needs to sell, those opportunities and those deals are out there. I was actually, I was showing a condo to a client the other day and his father was with us who, name will remain unnamed, but very much like someone who knows the real estate world. And I said, well, you have to figure, yes, Donald Trump was a, great. Now I'm going to definitely get an email. Anyway. And
he's in real estate.
Not Donald Trump.
No, not Donald Trump.
Anyway, so I said, listen, if we're looking, let's assume that average price for a condo is about $1,000 a square foot. And he looks at me and goes, was. He's like, try that again. And I said, yes, thank you. Yeah. But he's 100% right. I mean, I was saying was average for the last few years. Right. And now 800, like if you're in a good building.
It's interesting when you think of like all the different markets that we are involved in as investors and as Canadians.
Sorry, interrupt you. He goes, this is the time where you grab like 2 or 3 of them, you hold on to them for 10 years, and you're laughing in the long run.
But again, so I think it goes back to the basics of finance, right? So whether it's real estate, whether it's a stock, whether it's a bond, I think the majority of Canadians have been led around by newspaper articles and by talking headlines about, first they bought tech stocks, then they bought cannabis stocks, then they bought Bitcoin, and then they've all bought real estate, then they flipped houses, then they didn't flip houses.
Remember when I called you about Bitcoin and you were like, no, Rachel.
Like, stop it.
And I'm like, no, but you're like, no, stop. And I'm like, okay.
Right. So, I think there's a fatigue of people out there saying, well, the next opportunity is X.
Oh, there's so much fatigue.
There's a lot of fatigue out there. So I think one of the solutions to that fatigue and what we've found on our side of the business, and it ends up creating informed decision makers when it comes to big decisions like should I buy a condo, should I invest in whatever it is, if they don't have a plan, if they don't have a picture of where their finances are at, if they don't know what's going on with their income and expenses, then they really can't make these decisions wisely. Right? And what's happening for the last number of years is they didn't need to be so wise because the stock market went up, the real estate market went up, everything kind of went up. So it was
and there was money for everybody.
Right.
And the government was giving you money.
And by the way, when the stuff went down, it came back up really quickly again. So we've had these conversations with clients who've now seen their portfolio drop in 2022 and it hasn't really come back up a lot yet. Right? And so the challenge is in 2018, there was a quarter where the market dropped 25% at the end of 2018. In the early part of 2019, you recovered all your losses. In 2008, 2009, the market looked like the world was coming to an end. And by 2010...
So did the real estate market.
Right. And by 2010, everything came back to normal. Right? So we're used to big drops, big volatility, and then recovery. We've had a big drop, and we haven't had the recovery.
I was going to say, let's talk about that, because that's all... As we close out 2023...
Yeah.
I'm sure you're getting the same question. what do you think 2024 is going to look like? And I've had that conversation about real estate, but
Yep, it's hard to say. I mean, from a stock and bond market perspective, I do believe that bonds will start to shine in 2024.
why?
Because I think rates will top out, and as soon as rates top out, as soon as they say we don't intend on raising rates anymore, bonds go up 5 or 10% that day. So and then after that, if they start to lower rates by the end of 2024, you'll see bonds even go up more. So I think when we talk to clients about you should have a diversified portfolio of a mix of stocks and bonds, we're probably going to tell people to have their emphasis on bonds more than stocks.
Interesting.
And then from a stock side, I think it's going to be very specific to
The
companies.
sector. Oh, the company.
Even
Not
within a
sectors?
sector. Even within a sector. So,
Okay.
you don't buy the high-end retailers. You would probably buy the lower-end retailers because they're going to survive a recession better.
Okay.
But even within that, so do you like Target or Walmart or Dick's Sporting Goods? Right. So, like, these are all kind of on the middle to lower end of the spectrum of retail, but they've got a lot of money in the bank and they have no debt. They'll survive a recession. They'll survive a recession. So just as you think condos could be a good bargain.
For sure.
Right. So condos could be a good bargain right now because
And
they're
condos
down.
are like stocks. They go up and down. It's
Right.
not like the
Right.
detached market.
So I think it's challenging in the stock market to tell you where things will be because it depends on the stock.
Interesting.
Right. But I think overall, it's much easier to say, and I think you could probably say it with a lot more confidence, bonds will most likely do much better next year. And right now, being a buyer of bonds in today's rates, you're basically locking in high rates for the next 10 or 20 years. You can buy, whether you're a bond manager or you actually go out and buy your own bond, think of it this way. If you could buy a 10-year bond and it pays 6% right now, a Walmart bond, I'm making up the number, but let's say it pays 6% right now. Mm-hmm. For the next 10 years, as long as Walmart doesn't go out of business, they have to pay you 6% on your money and they have to give you your capital back at the end of 10 years.
Right.
So if you do it constructively and you do it well, that's not a bad number. But I think it goes back to what we talked about ultimately. It actually doesn't matter. If your plan says that you should get 6%, then that's a number that you should aim for. If your plan requires you to get 12%, then you need to take way more risk. Mm. If your plan requires you to only track inflation and get 4%, great. So, I think it comes back to the basics of finance, which have less and less to do with the return of any market, stock, bond, real estate. It's got very much less to do with that than it does to what's your situation. And right. So that's where we come in, right? And we hopefully provide some comfort to say, it actually doesn't matter. You need 5. So if you need 5, here's the way that you should set yourself up to get 5. And that's it. And then the challenge is, and we've seen this with lots of people in the last couple of years, circumstances for people can change very dramatically and very quickly. So 2 years ago, people had jobs and then they lost jobs, they get new jobs, they start new ventures and whatever. So if you had a plan 2 or 3 years ago, chances are it's irrelevant. Yeah. So that's the other part. So if your plan from 3 years ago and you're like, I haven't really talked to my guy and I know markets are down and it'll be fine, you should talk to your guy. And by the way, your guy should be me. But you should talk to your
first.
Yep.
No, but this is it's actually a very good, you should be talking to your accountant once a year. You should be talking to your financial advisor. You should have, it actually shocks me how many people don't have a financial advisor.
Correct. Because all they believe that we do is manage money, right? And that's actually not what we do. I mean, we do it to a degree and we hopefully do good jobs, but it's not just about picking the right stock. It's about why would you own that stock in the first place? Why do you need stocks at all?
But also, by the way, speak to your financial advisor before you buy a house.
Yep.
Like any major decision that you make, like you just said, it has to be the right time for you.
And interestingly, again, it goes back to things like risk. So we've seen COVID impacted people's health in a lot of ways. We see lots of that, especially with our older clients right now. And they've just gotten older. And what we found is, and we found this, I do a lot of insurance. Yeah. And one of the things that we noticed, and I believe this is interesting because it actually reflects on markets too. We've noticed that a lot of clients who kind of put off making decisions on buying life insurance, for example. Okay. So they put off making that decision during COVID because just stuff was weird. And
buying more life insurance or just buying life insurance?
Or just buying it in the first place or buying more or changing the type of insurance that they wanted to own or going from term to whole life and those kind of things. So they put off a lot of those decisions during COVID. They were scared. They just didn't want to do anything. Everybody kind of froze. Okay. In the past year and a half, we've noticed that people who it would make a lot of sense for them to own X kind of insurance, so that means they need to apply. Right. So what happened, the results of COVID are still being felt in weird places that we don't really know. So
that's an interesting point.
So an example is, we've had a number of cases now of clients who didn't actually see their family doctor for the last 3 years because of COVID. So
Are you about to make me neurotic? Like
a
what
little
now?
bit. They sit down with us and we say, we think you should buy some life insurance. And they say, great, let's apply. So,
Oh,
okay.
no.
So
And
they
they have to do
apply.
it?
And then all
They
of
have
a
to do a
sudden,
medical.
they have to do medical. And they say, well, and we ask them all the fun medical questions. Like, do you have any heart problems? Do you have
Like
any...
I took up smoking.
Right. Like I've been doing cocaine for 2 years. But no, it's like, do you have any heart problems? Do you have any cancer issues? And they're saying, no, last time I checked, that was all fine.
Yeah.
And then they do a nurse and turns out they got a heart problem. They just didn't know it because they haven't
Right.
gone to a doctor in 3 years.
Right.
So we've been finding...
Which is crazy, by the way.
Right. So even like when we talk about checking in with your guy, whether it's a financial advisor or it's
health
accountant,
check, yeah.
health check, everything. And people have ignored a lot of stuff in the last 3 years, and that comes back to roost. So I
Do you think that'll continue to move into 2024? Like I want to talk about so they're calling a recession. You and I have talked about this
Yep.
offline. Like we've been overdue for a recession for how long? How many years?
At least a decade, I would say. And I think the Canadian...
We were overdue before COVID hit.
Yes. And I think the Canadian recession will be worse than an American recession. I think that the Canadian recession, because of the average Canadian's debt levels
Right.
and what they owe on homes that might not go up in value and may go down in value, and you know these markets better than I do, but if all of a sudden people get all these renewals at really high numbers in 2024s, and they all have to sell their homes at the same time,
So-
does that flood the market?
Right.
Like, I don't know.
Well,
I
first
actually
of
don't know.
all, the market on some level is flooded compared. Like so October numbers came out and we saw a second month of double-digit increases in listings and a decrease in sales volume, right? So
there's
in
lots of homes on the
September,
market.
and remember these are always like rear view mirror numbers. I actually think less is coming out now in November because people are seeing that they can't sell anything.
They're just going to stop.
But the sales are like even worse. So 44% increase in listing volume in September, 38% in October.
That's big numbers, right?
Huge numbers. Now, a lot of that came in condos, like investors dumping properties, people who also can't afford, they're seeing their renewals coming and they're dumping their properties. But I did like a quick run of volume of condo listings in the portion of the downtown core for a client. Since November 1st, 2 condos sold. 156 for sale.
Right. So when you so let me
That's
ask you. So when you
72
think of
months of inventory.
when you think of 2024, so let's imagine. I would imagine that by the end of November and December, things pause for Christmas and things slow down. Ish.
Yeah, I was usually by mid-November you were going to see a slowdown now.
Right. But then come the spring of 2024, do you think that continues?
So it's interesting. I will tell you my buyers would buy something tomorrow. Okay, so I believe the demand hasn't gone anywhere. What's happened is everyone's scared of everything. Okay, potential World War III. Again, going back to headlines, are we going into a massive recession that's a stagnation? Most people don't even know what that word means, so all of that stuff. Okay, so
Stagflation.
Anyway, so I would say
Stagnation's like a place where you go.
Did I say stagnation?
You said stagnation.
Oh, can we edit that one out too? Anyway, so
Right. 'Cause I think you're gonna get a troll on that one. It's not like
so gonna
where
get
do you
a
live? Stagnation. Nice. It's like Kiss Nation, like the band. Like
my husband somewhere is laughing hysterically because I literally make up my own words.
it's great.
Anyway, having said all that,
We're getting t-shirts.
let's go back to
Stagnation.
Carhartt.
Carhartt with a car. That's good.
Okay,
good.
going back to the podcast.
Yeah.
So here's the Bank of Canada. So it's like a multi-point that I want to make. Like I always listen to the Bank of Canada. They come out and they're like, okay, we're not going to raise the interest rates, but then it's like it's parental like fear. They're like, but we're
We
not
might.
taking the pot, but we might. Right. So behave yourselves and don't spend money, or we're going to punish you. Okay. So then there's this point of the fact that, yes, there are all of these stats to show that those people that booked in that 5-year rate at 2% are now going to get hit. By the way, most people have already felt it because they were on variable. Most people who were in the worst position took the variable. Okay. Right. But let's assume that there's that portion also as well. The Bank of Canada isn't going to let that happen. They have the ability to bring those rates down. We still have increased immigration. That's not going to stop. We still have a lack of housing. So the question to me is, where's that moment where things start to shift? Right. Because the demand is there.
Don't you think the demand, though? So here's a question: don't you think the demand will continue to wait? Because if you're a buyer, you're thinking, well, stuff might go down more. So there's probably a lot of demand, but maybe they're just holding
Yeah,
back.
but yes, but I have buyers right now who are like they want out of their rental, like they've got an interest rate, they're ready. Like when you
They're
make
good to
the
go.
decision to do it, you ready to do it. So I think, and they said like they're waiting, like literally just waiting for a piece of inventory that makes sense. Historically, very similar, like history repeats itself. Spring is always a better time.
Right.
Okay. So again, this whole business is really psychological. It is. People still need four walls. And as like you said, you know what? People have children. They lose their job, they get a job. They get a job outside of the country. They have to move. All those things. So life happens outside of the stock market and the interest rate. So all of that as well, right? Yeah. Even in 2008 when the housing market bottomed out, I think we still had something like 46,000 transactions. Yeah. That means 46,000 buyers and 46,000 sellers still moved in the worst market we've seen in decades. So come along, you've got spring, you've got hints of the fact that we've got these great low prices. Rates are going to come down. I think
it'll be a good market.
Will it be a great market? No. Will we see what's not selling now sell for 20% more then? But we will have activity and people will come out to play.
Interesting.
And listen, by the way, way smarter people than I did got COVID wrong. So this is my assumption based on things that I know and history and whatever.
Well, and I think that goes
totally different.
And just to end on that, I believe that always goes back to as long as you can do what's right for you, finance is personal. Right? Finance is not public. Finance is personal. So as much as markets can go up and anything can happen and a bank can do this or a government can do this, every decision that a person's making needs to be personal. Can't be based on the big picture stuff. It's got to make sense for you, your family,
right?
Your
Are you
income.
Buying your first place? Are you going to be there for 5 years? Are you buying your forever house? Are you staying there for 25 years?
As long as they're taking care of the personal, everything else becomes less important.
So, okay, so your prediction is, we'll end off with your prediction. So you believe that the U.S. will not have, we'll have a deeper recession.
Canada
Do you feel
will,
like it'll be worse or you think it'll be longer?
I think it'll be both. I think Canada will have a worse and longer recession than the Americans will. I think bonds will probably do better or at least just as good as stocks next year. And I think that, as I said, I believe that interest rates will most likely top out. And then you have to, it's one of the things, there's a great expression, I think I might have said it last time, but you never know who's swimming naked until the tide goes out. So that was a quote from Warren Buffett always talked about it. So I think in 2024, I think those people who have a plan, so when they're prepared for whatever comes, if they've got a plan, they've got a plan that takes it into account. If they don't have a plan, they're screwed. And they could get lucky and they could have bought a pot stock at the right time, and if they cashed out at the right time, that's great. But I think ultimately, if they've learned anything in the last couple of years, it's less and less to do with that particular market or that particular interest rate, and way more to do with, do you have a plan? Have you updated that plan? Have you told the people, like you said, your accountants, your financial advisors, your lawyers, your health guys? Does everybody know what's going on so that they can help you? If you're going to pay for advice, take the advice.
Well, and I was going to say the other thing that I would leave people with going into 2024, if you are going to make a move, if you're going to buy something, you're going to sell something, if you're going to do anything within an investment perspective, whether that's stocks or not, whether it's a home or not, make sure you've got the right person advising you. I will say, I think a lot of people in the height of COVID that bought at the height of the market didn't necessarily have the best. Listen, I'm not disparaging anyone, but the stats show 85% of all agents don't make it to year 5. Right. That means that the majority of agents that are walking around are tourists. They're tourists in this business. Yeah. So a lot of people went out and they were like, my buddy just got a license. I'm going to have them help me buy this house. And
they're not doing their homework.
They're not doing their homework. And by the way, the other day I got referred someone. They were like, I'm going to be interviewing agents at the beginning of December. I went, good for you. Yeah. Like, it actually surprised me how many people come to you, even you, and they're like, oh, someone told me they were great. And they're like, hi, I would like you to help. No, go talk to four, investment advisors. Talk to four agents. You would never have your bathroom remodeled without having three or four contractor. Yeah. But yet people just walk into anybody and be like, oh, my sister used you. You must be great. Not necessarily for you. They could be great, but not for you.
And the professionals who do it well are never threatened by that, right? That's fine.
Exactly.
Yep.
I actually welcome it. I really, because if you end up coming back to me, you've thought it through. This was the right fit. We work together.
I just assume they're coming to me because of my looks. Like, I just assume.
Yes, for sure.
Yeah.
For sure. And on that note,
yeah,
we look forward to seeing the best looking guest on Leverage
100%.
back to us soon. I wish you safe travels home.
Thank you.
Everyone be safe
Thank
in
you.
Israel.
Thank you.
And